Hi everyone, good morning. Thank you all for joining in on a Saturday morning. I know that there was some delay because I was told that we had to wait for a couple of more participants to join in, but I think I've been given the go ahead to start. So this is very interesting for everybody here because we consider gold and silver uh, as luxury here in India, and we do think that we use it. Our use cases are a lot more than what they are on the global side. But the case becomes very interesting right now because we are in a sticky inflation, high interest rate sort of a scenario. And this is a webinar that I had done, for our PMS clients. And so I've taken a lot of stuff from there to make it simple, and I try to make it simple and have an interactive session with all of you. Right? So why allocate to gold at all? Right? That's one question that everybody gets. Anytime when the equity market does extremely well, uh, and when people start talking that we have to go towards a multi-asset approach now, people start questioning that decision and say no. Interest rates are not very conducive. We are just getting 8% on FD. We are just getting 7.5 on debt funds, and gold is a conservative asset, right? So I actually want to address this part. Is really a conservative asset where you have to think whether you should allocate your investments, whether you should allocate your savings into gold. Right? So if you look at this chart, uh, this is a chart that keeps coming up on LiveMint. This is publicly available data, so I've just taken publicly available data. So if you see in 2010, right, 2010 and 2011, this was right after global financial crisis. So gold did extremely well, and then there were years when gold did not do well. So one thing that everybody needs to understand, be it gold, be it debt, be it equity, everything is cyclical in nature. Right? Any investment decision that you take needs to be from a cycle approach to see where you are in the current cycle and what makes sense for you to do. We keep getting queries on how it makes sense to do small cap, but if you look at the historical performances, YTD, that is calendar year, if you say 2022-21 were the only years where in the last 3-4 years is when small cap performed well. But had somebody invested at the peak of 2018, that is maybe January of 2018, when the market started to peak out, uh, your CAGR returns for so many years would have just been low single digits had you not put in any inflow. Okay, this is publicly available data, right? So you look at gold from 2013 all the way up until 2015, gold has been underperformed. Okay. You saw international equities, you saw small caps, you saw everything else do well except for gold. We did have a big crash on the gold side. And then from there on, the scenarios for gold have been changing. Gold has been picking up. Right? Why it has been picking up? If you see from 2018 onwards, we've been having a lot of geopolitical concerns. Right? There was a trade war between US and China. Then COVID came. In a sense, then the Russian war came. And then we had a crisis in commodities where supply issues were very high. So every time since there are more geopolitical concerns coming up, you're hearing of China trying to invade Taiwan, anything that is coming up on the geopolitical front, right? Today we are in a scenario where geopolitics is going to play a huge role uh, uh, in macroeconomic calls and macroeconomic decisions that governments also make now, right? So anytime when the scenario poses a risk, right, uh, and supply becomes an issue, you see inflation start to go up. And when inflation starts to go up, your currency is sort of getting hit, which means that for a large country with a strong currency that is at risk of becoming weak, there are alternate currencies that take role. So, for example, 2020 people saw a lot of talk on crypto. Though it's not a valid conversation for us to compare gold and crypto, because you have to compare gold and a currency, because at the end of the day, gold is a currency. It is not to be compared to equity. It is not to be compared to debt. It is to be compared to a particular currency. Right? Yes, there are correlations and relations to equity market. There are correlations to interest rates. There are correlations to inflation, which means you can only relate it to that. But at the end of the day, the ultimate decision that you need to take is towards the currency. Okay? So from 2018 onwards, we've been having a lot of issue. And from there on, if you see, gold has been a consistent performer. barring 2021, but still from a high base. It is still at a high level, right? If you compare it to 18, 19, 20, it has done consistently well. So what I'm trying to say is that there are cycles that keep coming up. There are every time a winner is different, every time a loser is different, right? And what we have noticed is gold is one such hedge towards geopolitical risk, towards currency risk, that works in a bad scenario. And we do think that uh, uh, these concerns are here to stay. These issues on inflation and interest rates are here to stay, right? So how do you value an investment like gold? Now, when we talk about gold, we don't really know how to value physical gold, right? We just go to our jeweler. He will give us, a price, and then he will add more cost to it, and that is the price that we pay, right? But how do you really actually value gold, right? Because we are looking at this from a mutual fund perspective. We are looking at this from an investment perspective. So how do you really value gold? So you value gold based on supply, demand, and utility, right? Now, the supply of gold is not increasing. Right? If you see gold mining companies all over the world, they are producing. So the largest is producing only 6 million ounces a year, right? And demand continues to keep going up because the use cases of gold are very high. In India, Asian countries are the largest consuming gold nations in the world, right? If you look at central banks hoard physical gold. Right? So they have it on their balance sheets to hedge their own currency. This is what happens with how they use gold. So this is how we've been using gold. We use gold as a luxury item here. Our use cases of gold are very high. So when you look at gold, you only have to look at gold from a supply and demand perspective. And we are in a scenario where supply is low. It's not increasing. Right? It's not increasing, but the demand and the use cases of gold are increasing and getting very high. Okay? So this is the gold demand. So if you see, gold demand has been very strong since 2010. Right? There are a couple of quarters where gold demand is not very strong, but overall, gold demand since 18 has been very strong. And where is it actually coming from? So if you see, it has been coming only from the central banks, which means that central banks and jewelry. It's right. So demand is very very high, but supply is very low. So usually what happens is, how does silver get mined? There are no particular areas where you go and mine silver. It is a byproduct. It comes with gold. So you start mining gold, you go down, you take out gold. Along with it, your gold equivalent is what they call it. You start getting silver and you start getting other metals also. Right. So it comes along with gold. There are no particular mines outside that do this. So the larger gold mines also do have access to silver, and that is how silver supply is coming in to meet that demand, right? But it is not silver versus demand. It is silver and not silver versus gold. It is silver and gold, right? You always have to remember that. So because the supply also is low and the demand is very high, silver tends to be more volatile than gold. Right? This is for the simple reason of liquidity. Right? Silver doesn't get traded a lot much. So it is more volatile than that of gold. Okay. Can there be a best currency? This is how we were talking about how you cannot peg gold to equity markets or debt markets. You have to peg gold to a particular currency, because before the gold standard came off, gold was a barter currency, right? Which means that you give me gold and I will give you something else in terms of my services. Right, it was actually a currency. So it still is actually a currency, because you are seeing central banks continuously buying gold to hedge their currency. How do they hedge their currency? When their currency becomes weak and the gold in their country starts doing very well, it is a hedge. So they net off that with their own currency. Right. So can there be a West currency? No, there is a currency war. So if you see today, global scenario is such that you are seeing the yuan getting devalued. You are seeing the Japan getting devalued. There was a brief period where Russian ruble was the best performing currency in the world. Yeah. Right now, India has only depreciated against the US dollar, but it has appreciated in terms of all the other currency. Last 8 months has been a different scenario. But when there was the war, India was in a much better state than other currencies. Right. So if you look at gold performance alone in USD, from since 2000, your average happens to be 9.5%. So anywhere in any currency, right? No matter how weak that currency might be, no matter how strong that currency might be, gold tends to do extremely well. It's a risk-free asset. So your long-term equity performances, your long-term equity averages happen to be in the range of 9 to 12%. Okay, so anytime you invest in the equity market for a long term, now long term doesn't mean 2 years. Long term means more than 10 years, right? Because you need to look at equity from an ownership perspective. These are your financial assets. You will not trade in assets, right? You will not go trade in your house every 2 years or so. You stay there, you stick there. So you need to treat them as financial assets. They are your savings. And anytime you stay beyond 10 years is where you sort of be in the range of 9 to 12%. And that is the, so if you compound at 12%, you're effectively doubling your money every 6.5 years or so, right? That's Excel math. But fundamentally 9 to 12% on an equity market with you're taking business risk, still that is a good reward, right? But here you're seeing a risk-free asset like gold give you very similar returns, 9.5%. This is average. This doesn't mean that they will continue to give you, because if you see Indian gold over the last 3 years has done consistently well, right? So this is just a number that you can keep in your mind to know how gold really moves, not how it will give you at the end of the day. Because scenario today is much more different than the scenario that was there 5 years back, right? So in any currency, if you see, gold has done phenomenally well. If you look at silver, also silver, as I said, is much more volatile than gold. So silver averages are much more high. And if you see the reds are far more higher than that you saw on gold. So I'll take you back to the gold side to see how many reds are there. It's just year specific. So if you see 2004, 2013, 14, 15 is where we saw on the chart also. In the quilt is what we call it. The red years, and here the red years are far more superior to that, and it's not consistent. There are some years where in one particular currency it's more, in one particular currency it's less, right? So it's much more volatile. So you must have a basket approach when you look at precious metals like gold and silver, because they work hand in hand. So but volatility in silver is much more higher than that of gold, right? Now let's go the extra mile. Let's look at the companies that really mine gold. Like I said, it's very difficult for companies to mine gold, right? You cannot go put up a plant. There are political instabilities in certain countries that don't allow you to come up with a plant. So basically, anybody who has been in the business for a long time stays in the business for a long time. Right? And now the cycle for mining, for gold miners, has been very long. So if you saw from 2000 to 2010, central banks had been selling gold, right? So and the demand for gold was also going up, right? So to bring in more supply, because what supply was coming from the central banks was immediately going off, it was getting used up. So to bring in more gold from 2000 to 2010, gold mining companies went into expansion. And the only way for you to expand very fast to meet the demand is to take on debt, right? Any business owner would know this. I want to expand to meet the demand. Let me take some leverage and then do it as soon as possible and do it fast. So 2000 to 2010 was a massive expansion for those companies. And when gold prices went down, that's when these companies started to go bust, because balance sheets had become very fat. The debt on their books were very large. So what happened was there was a wave of consolidation. Right? So the smaller players either got out or were taken over. Right? And in 2008, the premiums that were being paid itself to buy out a small mine was very, very high, 20, 25 times. Right? So that the rationality came into the market, where they started seeing after gold prices go down, some exited, some died, some were taken over by larger companies. So the larger ones effectively became much larger. Large became larger. And all they had to do was clean up their balance sheet. So they went into deleveraging. They were paying off their debts. They were making sure that the plants were very efficient. And from 2015 all the way up until 2015, that was the phase where they started ensuring that their balance sheets are in a good shape. So from 2018 all the way up until now, they are in the best shape of their lives. They are making very high free cash flows. Last week also was the result, and they were making very high free cash flows, right? But if you see these companies to the overall energy sector, it's barely 1/5. Right. The mining industry, which has gone through waves of consolidation, has gone through waves of deleveraging, and is making very high free cash flow. Yet it's not reflected in the uh, uh, valuations, which does make it a good case for you to see as to why it's not happening. Right. And if you look at technology, technology is in another. It's in its own high, right? But comparing industry to industry, energy to energy, it's only 1/5 of the energy sector in the US. Right? These are listed entities in the US. Right. So this is what I was talking about, how there has been very high cash levels in mining and gold and silver miners uh, in its history, right? And they continue to make that. Right. This makes it a huge case. This is the last time that we saw in 2010, but last when we saw was when these sorts of companies were taking on debt to expand. Here today, we are not seeing any much expansion taking place, nor has the wave of consolidation started to take place. Right. We recently had a deal between the largest mine in North America buying out a largest mine in Australia, and the premiums paid were fair. They were not very high. They were fair, right? Which means that the industry has learned from its mistake. It's not making the same mistakes. At the same time, they're not overpaying, and they're letting the economic environment run at its pace. Right? They are not trying to overshoot their targets. They are not trying to undershoot their targets. They are going with the industry, and naturally, if gold does well, they would also do well. Right. 7 years of deleveraging that has taken place. You saw from 2004 to 2014, right? I was talking about 2010 when it peaked, but still after that, a couple of years also, they were getting very fat. And now, for the last 7 to 8 years, they have been deleveraging and they've been getting leaner, right? So all your balance sheets are in very good shape. Plus, they're making cash. There's no capacity addition that's coming in, and the industry is rational, which makes it a good use case for any investor to look at. Low capex. So if you see capacity expansion has come off its peak in 2014, all the way down. This is for silver also. So I thought I'd put something for silver. This is what I was talking to you about. Low capex, high cash, consolidation already taking place. Right. Now, in terms of valuation, how do they look in terms of valuation? They have been the cheapest since 2015. So the market has not really looked at, they've not believed the story at all in terms of how gold miners operate, where they were being valued at as to what they are being valued at currently, these mines. See, you cannot replicate these mines, but at the same time, there is that overhang of fear that no, this is that industry that is prone to high cycles. They are very cyclical in nature. They are prone to deep troughs and of pessimism and very high optimism also. So market understands that there are risks in this entire space. When you look at gold, when you look at silver, when you look at gold mining also, and this is where they are. So they are trading at a discount to gold. Right, but it does make a huge use case. Knowing that yes, these are the risks that are there, and when I purchase a particular mine, I am not overpaying for these mines at all. Right. That's all that I had to share for gold, silver, and mining. So I'll open the floor for questions, and whatever questions any of you might have, please put it in the chat box. What are the good gold miner companies to invest in? See, they are already listed. There are fund of funds that are available in the Indian market also that you can use to see. I don't want to name anything because it's a public webinar, but I can say that yes, there are fund of funds that you can look at. They disclose their holdings, so you should look at them. Why is there an attempt to increase production of gold and silver when capex is low and demand is high? See, it takes 7 years for a mine to go from research and development all the way up to commercialization, and it takes a lot of money. See, today you don't know when you there are innovations to take place in the entire industry because a company can't keep going to any area and start digging out thinking that they'll get gold. right? There is a lot of innovation that takes place, that has to take place. There's a lot of research and development that is taking place, where they want to reduce the time that it takes by using AI, by using technology. But ideally, the industry works like this, where it takes 7-8 years for them to go from zero to having physical gold in their hand. Right. So it's a tiresome industry. There's a lot of labor problem because they operate in areas that are and it's gold, right? So there will always be political interference that's there, and they operate in large countries as well as smaller countries, right? So it's very difficult to increase supply in the first place to meet that demand. So that's why the industry has learned from its mistake that you cannot go out and keep spending and let your mind be idle after some time where you're losing out money, because there's a lot of money that's being involved, right? So they have been understood, and that's why you say that there's low capex. Not that there's no capex, there's low capex, right? There is capex, but it's not as high as what it was. So they're being very prudent in capital allocation. Can you please share the slides to our email ID? No, sorry, I would not be able to do that. To share to the email ID. That's why I'm here to spend a good 1.5 hours with all of you. But we cannot share presentations. We can share information, we can share podcasts, and we can share these are all public. We have already done this multiple times, so you can just go, you can just search for a podcast, or we can have your point of contact send you such information. Can you buy shares of mining companies? If so, let me know the names. See, in terms of this is what I was trying to tell you. You have to take a call on whether you want to buy shares or whether you want to buy straight from the FOF. So we have been doing the FOF route since 2018. And you can get in touch if you're not on the program yet. Do get onto the program. You can get in touch with our point of contact, or and reach out to them, and they will help you start doing those investments with us. Right. As part of M2W, is there any gold and silver related funds advice? So yes, do get in touch with your point of contact, and we can do it for you. Right. So do get in touch. So they will help you and they will guide you. But yes, it's a good idea to look at. Is gold still attractive at current levels? See, gold has been attractive for a very long time. And if you see in India, they have done extremely well. Right? But with the scenario that's there today, that poses us with the risks that are there globally, right? Macro risks are very high. You are seeing risks in the US come up in terms of their global banking scenario, their banking scenario. You are seeing risk in terms of there are country specific risks, there are currency related risks. So the risks are high. When the risks are high, you have to go towards assets that are fundamentally strong. Right? For equity, you always tend to pay a premium, right? But you need to go towards assets where fundamentally they are well supported, and fundamentally you know that in historically they have done very well in terms of bad scenarios. Is SGB a good investment compared to ETFs? Is there a way to buy silver digitally like gold with similar benefits like SGB? There's no SGB type option for silver. See, SGB is a very good investment when you want physical gold. When you want to use physical gold, it's a very good case, and plus you get interest on it also, right? So for that particular use case, yes, it's definitely a good option. ETFs and mutual funds are more from a growth option. See, either ways, Indians will use gold, right? Whether you go to SGB or whether you do ETFs and mutual fund, there will be a day when you have to take out gold money and buy gold itself, right? But right now, SGB is as an option is very good for people who want to buy physical gold, and for people who don't want to take the storage cost, people who don't want to take additional cost, but at the same time make use of gold as an investment, they should look at ETFs and mutual funds. Hi, for young investors, which gold investment is best, physical gold or gold? Again, it depends on your use case. Both are very good options. It's just that there are costs involved on the physical gold side. So if you can take up those costs and there is a use case for you, please do take it. Like equity investment is the long-term horizon duration of 10 years recommended for silver as well. See, for any investment you take, you need to stick from a long-term perspective. Today, Indian families also are using the gold that they bought 10 or 15 years back. Right. Then they continue to keep buying gold, right? These are assets that you keep using, and you give them to your next generation also. There is a big use case in Indian family, right? So having a long term duration is always going to be beneficial for you for any asset, right? Silver per se, you only need to look at it from demand perspective and price perspective, because the use case of silver in Indian families is not very high. But there are trends that are emerging. People are using silver in jewelry also, but nonetheless, you need to have a long-term duration for any investment you make. It's an investment. It's an asset. You're not going to trade your asset continuously, right? You're not going to go shift from one year to the other year, one asset to the other every year, right? So that's how you should look at these assets. Please share good mining companies. Again, there are fund of funds that you can look at that they disclose their holdings. So if you are on the program, we will guide you. You can get in touch with our point of contact and we will guide you. Regarding taxation, what is your thought in terms of physical gold versus gold ETF? There is a capital gains tax. Can you brief about best countries taxation and gold funds? Best countries taxation and gold funds, I'm not aware, because majorly there it is ETF, right? And in India, capital tax is there. You cannot go like this. Please go straight in terms of tax. Pay it, finish it. If you want to go, and it again depends on your slab also. But in terms of physical gold or gold ETF, I would say for any investment, tax is here to stay, right? You cannot avoid tax. You cannot go around tax and say, no, I'm not going to pay. Yes, you have to take tax as a given, right? And that should not be your decision-making factor, right? Tax is going to be there in every country. Tax is going to be there even after you're not there. Your next generation also will keep paying tax, but that should not be your deciding factor of how you look at an investment. If that is your deciding factor of how you look at an investment, then you will never be able to make good investments in the future at all, right? Be it this or be it expense ratio. Today there's the last couple of months there were papers on how they want to make it single and then add another class of where you have to only the expense ratio for performing funds will be much more different, right? But again, these should not be your factor when you decide to make an investment for such assets, be it equity, be it debt, be it gold. See, physical gold ETF, physical gold are different, right? Physical gold market is now only developing. If you look at MCX, there is a particular price that it gets traded. Right? Gold ETF is very liquid, right? You are seeing it is on the exchange, right? But you go to physical gold, there will be different prices, but hovering around one particular price of MCX or the bullion price, right? So it depends on liquidity. More liquid, more efficient is the price discovery. That's why I would say, ETF works when you just have a growth mindset for gold or silver, because price discovery becomes much more easy, right? So that's why you're seeing discrepancy in prices. So more liquid, more participants on the exchange, more discovered will be the price. What is the advisable percentage of gold in a portfolio? What is the best way of position sizing? Can we just start buying 3% initially and buy more as it goes low like equity? This doesn't work like equity. The factors that lead to a change in price is more on the macro fundamental perspective than to do with equity markets, is what I was trying to tell before also. Right? But when you start buying initially, 3 to 5% is good, and scale up well. See, because these are not 10 years back, price of gold was different. 10 years back, price of silver was different. Today, the price of silver is much more different. You are seeing it's more like a staircase. That is the approach that is happening for these commodities, right? But you cannot think that because equity is going to go low, I'm going to wait for commodities to go low. In the US, gold has been going down, but in India, gold did not go down. Right? So it's country specific. It depends on the macro fundamentals of the country. But prices do tend to behave as what they do in the US, because US is a highly liquid market when it comes to equity or gold or any other commodity that's there, because liquidity is very high there. That is uh, just a reference for you to look at how what is happening from a sentiment perspective, right? But you should start buying 3% initially. If you're on the program, do get in touch with us. We will guide you as to how much we think is the best percentage of gold to have in your portfolio, and we will also look at your overall wealth to see how much gold or how much commodities are actually there and how much you need to have. So do get in touch with your point of contact. If you are not on the program, do get on the program. The commodity exchanges are more to do with traders who have physical gold. You should not enter into that unless and until you have a very good command on commodity futures and commodity options. That's why you have ETF as an option. It's just long only. So ETF is the best option for you to do. Is gold only for elderly people, or can anyone accumulate for long term? There is no such case that gold is only for elderly people. I don't know where this information is being given that gold has to be for elderly people. I'm quite young, and I also do have. I do also think of how my use for gold is going to go up in the future. So it's not for elderly; it is for everybody that's there. Right? These are assets that you need to have. And culturally, also we are more prone to buying gold. And if you see anywhere, anyone will tell you that no, gold is always an investment that you need to have, right? So so gold is not only for elders; it is for everybody. Thank you, sir. So we do have a couple of minutes. I'm very happy to address more questions. So if anybody has any questions in terms of gold, in terms of how gold behaves, silver, mining, I'm very happy to address. So you need only after 20 years physical gold. So of course you should look at SGB as an option, gold ETF for growth. But either ways, right? We have seen this in the past also, where we do assign that I have gold in the digital form, I do have gold in the electronic form, so I'm going to use that gold only for physical. Right. Ultimately, that gets used for any house goal or any marriage goal or any other goal that's there. But ideally, the switch is what we've seen is from gold mutual fund or SGB or ETF to physical gold only. Right. So if you're getting a good price on the physical gold and you are able to take such cost or storage cost, then you should take it. Right. But the easiest option for you is to go towards ETF and SGB. Right? SGB is still not highly traded, so you cannot trade it. You have to look at it from I'm buying it and I'm continuously buying it and I'm getting some interest for my gold that I'm parking with RBI. Right, that is how you should look at it. HUI index is decreasing, but gold price is increasing. Why is it contradicting? See, this is a question that even I ask myself when I go to sleep, because the relationship is this, right, where it is supposed to act, it is supposed to go up. But because they are equity in nature and they have had deep cycles in the past, investors are very averse to it. They are very averse to it. Now, if you had a bad experience, if anybody had been in the 2000 to 2010 commodity cycle, after that the bust made investors really averse. It took them up until 2021 to come back into the commodity market, right? This is in India when you look at steel and aluminum players, right? Pure, right? So that overhang happens to be there for investors because the market has had a bad experience, right? So when things start to change, it takes time for people to notice it. There was a time when people did notice it in 2020, where gold mining did extremely well because of gold prices went up because of COVID. The entire market was not doing well, but these are equity instruments that were doing very well. Right. So yes, there is a correlation. Sometimes there might be a disconnect. Sometimes there might be a disconnect for at least 2 to 3 years, but nonetheless, they do catch up. Can we buy SGB in the secondary market and still get the tax benefits and maturity? That I will have to check, because usually we participate only in the primary issue, but I can have that checked. You can get in touch with your point of contact, and we can give you the exact math also if required. Right? What does What do you mean by HUL index? No, it's HUI index. It's basically the gold mining index. Great. I don't think that we are getting more questions. So I think we can close. So thank you all for joining in on a Saturday morning. I hope the information was very valuable to you. If you are not on the program, do get onto the program. We will be able to guide you in terms of how you should look at these investments and take a call. Right. Thank you so much for joining in. Have a great weekend. Thank you.